Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. Let's look ahead to the upcoming Eurozone inflation readout. It's going to be absolutely massive for markets and could potentially lead to outperformance for European equities compared to their US counterparts. Certainly coming at a period of time where people are really fearful around what might happen in terms of US interest rates, whether we might actually not see a single interest rate cut this year from the Federal Reserve. Things look relatively different here in Europe, and certainly the Eurozone inflation gauge is going to provide a very timely reminder of the strong chance that we will see an interest rate cut from the ECB in just 6 weeks' time from now. Let's guide you through exactly what markets are expecting and why this is particularly important for traders. First and foremost, you can see here that the data is coming out on the 30th of April on Tuesday morning, 10 a.m. UK time. The expectation here is a point towards a decline to 2.4 in that headline number, the core reading down to 2.8%. And that really rests on another strong monthly metric. But that's going to be absolutely key. Do we see another strong number or do we not? And if we do see a relatively low number this time around, it could provide the basis for that June interest rate cut. In terms of the wider picture for Eurozone inflation, we can see that it's a relatively mixed bag, but all really converging towards that 2% target. Italian inflation, most notably, well below that and actually turning upwards of late. You can also see Spanish inflation really struggling to make any meaningful headway back down to target. But Eurozone inflation continues to decline, and the expectation is that soon enough we will see a move back down towards target. And we can see one of the things that has undermined its trajectory recently in terms of there's a good chance that we could already be at target. But instead, we've seen this massive pickup over the past 2 months. February and March both giving strong readings for, well, across the board, but certainly you can see for the Eurozone, it's provided the biggest monthly figures on the past 2 months, essentially, both February and March. It was the Eurozone that saw the biggest monthly readouts, and that really did dampen expectations. That being said, as we can see on the bottom, in terms of the 11-month annualized figure, i.e., if you take the last 11 months, you find the average rate of inflation or monthly inflation, and you expect that average to play out for this month. Which one's best equipped to get back down to target? Well, it's the Eurozone, 1.94. So whilst markets are expecting to see inflation remain at 2.4% here, you can also see that if we just saw an average readout in terms of inflation, average for the last 11 months, we would get back down to target. So there is the possibility of a significant decline if we were to see that. So here's a breakdown at 2.43%. You can see at the top end of this chart, the middle section shows you that those last two sort of chunky monthly readings, the last one 0.76. What we need to see in terms of this disinflation is a much lower figure. And you can see, casting our mind back to this time last year with that April figure, it was 0.64. So that's what's being replaced. So if we see another third consecutive reading, sort of strong monthly reading, then maybe we will just stay still. And maybe that would dampen sentiment around the possibility of an interest rate cut in June or a return to target before long. And the reason for that, as you can see on this chart, is that this April 2023 reading alongside its two prior readings were relatively strong, relatively solid monthly figures that when they're stripped out would point towards significant disinflation. But unfortunately, we've seen a similar kind of trajectory in terms of the February and March readings this time around as well. Will that happen once again? Well, look, if we do see a strong reading, let's say we see a 0.6, that would, like we've seen, essentially point towards inflation remaining steady at 2.4%. But if you then look towards last year and you see the May figure was pretty much flat, June relatively low, July negative. So that means that if we don't hit target this time around, we've got 3 months where there's a good chance we're actually going to see that year-on-year inflation rate increase. So that's not necessarily going to be the kind of thing that really emboldens markets about the idea that we're going to see an interest rate cut and the beginning of multiple interest rate cuts in the coming months. So really it comes down to this meeting. If we see a lower than 0.6 reading, then there's a good chance that we start to see a potential move very close to that 2% target. Suddenly everyone says, well, we're pretty much there. We're going to see that interest rate cut from the ECB. However, if we don't, if we see another third reading on the bounce that's relatively strong on a monthly basis, then you're looking at a strong possibility that inflation remains steady or moves higher. And then we're looking at 3 months where we're probably going to see more of the same. We're probably going to see upside in terms of inflation, and that could be damaging for sentiment. So there's a lot to pick through. I mean, look, this is the core outlook, and we can see again those core readings also very solid over the past 2 months. You can also see that last year we're stripping out that 0.98. So again, this is the last sort of very forgiving month that's being stripped out before we start to move into a period, a 6-month period, where those sort of base effects don't necessarily look as favorable. So this month is going to be absolutely key, and what happens should give us a good idea of the trajectory of inflation moving forward. So look, if we see another strong reading on the monthly core figure, maybe we don't see as much of a decline in terms of that year-on-year figure. Let's say we're at 2.95. Let's say we get down to 2.8. Some people might say, oh, well, we're still seeing disinflation moving back down towards target. But you would know that we are stuck in a rut where we're seeing very strong monthly inflation metrics, and the forthcoming 6 months look like they're relatively low comparatives from last year that will be very difficult when they're stripped out for us to better. So that means that whatever happens this time around, by and large, we're not going to see a huge amount of change from that figure going forward for the next 6 months. So absolutely key to note what's happening for this release. Here is the breakdown in terms of the expectations from markets from the ECB. The expectation is that we will see a rate cut in June. That's 64%. And by year end, the expectation is that we're going to have seen 3 rate cuts to take us back to 3.25, or the outlier view of 20% is down to 3%. So essentially, markets are very confident, essentially 2/3, that we will see a rate cut coming into play this time around. Well, that may be the case. And certainly if we do see a number in line with an average on that inflation reading, we could even get back down to target this time around. And in which case, you'd be looking at the potential for upside in terms of stocks. You'd be looking at potential weakness for the euro. But there's also the flip side of that if we don't do it this time around, there's a good chance that we won't do it for some time. So if we see a stronger than expected reading coming out, then because of what I'm showing you now, you should be aware of the risks going forward that we might see inflation flatline or even move towards the upside. Let's look through a couple of the key markets. First and foremost, this is the DAX. We can see the pullback coming into play through April. Well, we've staged a bit of a rebound at the beginning of this week, but it's starting to fade once again. The possibility of a decline back down to target does provide the basis for a bullish outlook for some. But at the same time, there are concerns, as I've shown, that if we don't do it this time around, we may not do it for some time yet. And so I think in terms of market pricing for those expectations, I think there's more risk towards the downside than there is benefit towards the upside, because market's already pricing a 65% chance, a 2/3 chance essentially, that we will see a rate cut in June. Well, if we see a strong inflation gauge coming out this time and an outlook for a struggle to move anywhere in the next 6 months, well, then that doesn't necessarily fill us with confidence. In terms of the hourly sort of intraday chart, we can see now we're creating these lower highs and lower lows once again. So that's notable. So I wouldn't be surprised to see a bit further downside as we head into this. It's a difficult one because by and large, this is a market that is intertwined with global sentiment. So what's happening in terms of the US is also notable here. But it's also notable that if we look here in terms of the sort of relationships between markets, you can see euro dollar here with this positive correlation to the ratio between the German DAX and the S&P 500. So that would point towards the possibility of outperformance for the DAX in the event that we see strengthening for the euro. That would be weakness for the US dollar. So that really highlights that it's a risk on play more than anything, if that were to come to fruition. In terms of euro dollar, I'll tell you what, let's just grab it on here and I will get rid of this. Let's just write it in. So here's euro dollar on its own. And essentially what you're looking at here is a sort of rebound coming into play. In part, this is going to be a reflection of risk attitudes within the market. You can see at the top end of this chart these lower highs, and that does provide a potential area for this market to weaken if we were to see further upside coming into play. I think by and large, the weakness that we might see for this could come less so from the idea that we're going to see rate cuts, but instead coming from the idea that we're not going to see rate cuts because of that haven aspect for the US dollar. If we were to see a number of central banks all having to push back expectations for their rate cuts, that again doesn't necessarily bode too well for the global growth outlook. So near term, we're rebounding and regaining ground. And we can see here on the 4-hour chart that how that's playing out, the sort of basing pattern, which means essentially we'd need to break back down below this swing low that we have here at 106.78 to break out from this near-term, short-term trend. So in the lead up to it, I wouldn't be surprised to see this continuing to play out. But I think the risks are geared towards the downside in terms of if we don't necessarily see that disinflation coming into play this time around, then if you can look further out, that would give us a wider basis for the possibility that we'll see the ECB having to hold off and not cut rates in June. So then it might come down to looking for commentary from ECB members after the release and alike. But if we do see a surprise number this time around towards the downside, we could possibly see people feeling even more confident about that ECB rate cut. That could give us some bullish sentiment within the market at the time, the potential for weakness in terms of the US dollar and an uplift for the euro. That won't necessarily play out across the board because when you're looking at euro, the potential is that we see weakness. Let me just, full screen this. There's a possibility that you'd see weakness for the euro if we're talking about a rate cut playing out for different markets, and in which case you'd be looking at it against other areas where you might see strength or a sort of more hesitant approach in terms of the central bank. And that would be more something like the euro against the Aussie or the euro against the New Zealand dollar, who I think alongside the US are likely to be a little bit more hesitant. We've of course seen that Australian inflation report coming out, the quarterly number of 1%. So that does put back the idea that we're going to see a rate cut this year. And in fact, people are pricing in a higher chance of a rate hike than a cut. So if we're looking for weakness in terms of the euro, I'd look at it against the Australian dollar if we see the inflation gauge coming out weak. But I think if that was to happen, we'd also likely see that haven demand for the US dollar dry up a little bit, and we'd see euro dollar pushing upwards. So different ways that it could play out, but certainly this is going to be an absolutely key report for people to be looking out for, because depending on which way it can go, this could either tell us that we're on the cusp of this ECB rate cut and that 65% all of a sudden becomes 80% and everyone feels like European indices are the place to be compared to the US because of the impending rate cuts. Or if we see this coming in high as markets are expecting and we don't see inflation move this time around, there's a good chance that we're going to see Eurozone inflation move towards the upside in the coming months beyond this. And therefore, question marks being raised as to whether the ECB are comfortable cutting interest rates in an environment that is by and large likely to see an increase in terms of year-on-year inflation within the region. So certainly a key one to look out for. I hope this has helped. There'll be plenty more analysis of some of these key announcements coming out over the forthcoming weeks. So keep an eye out on this one, and it will be likely a big market mover whichever way it goes.